Foreign portfolio investors or FPIs are fleeing the debt market, India's debt market. And the bond markets have become volatile. What really is happening and what is the impact of this on India's debt and credit markets? That is what we are going to discuss today in Macro Sutra. Hello and welcome. I'm YP Rajesh, Managing Editor at ThePrint, and I have Radhika Pandey with me from the NIPFP. That was the headline we gave to our question since yesterday, Radhika. Fleeing FPIs and volatile bond markets. Before we even go to who is fleeing and why things have become volatile, why should we, we are not people in the finance, trade or business. We are, let's say our viewers are ordinary, viewers who don't dabble in bond markets or debt markets. Why should we care about bond markets? What is the significance of bond markets to the economy?
See, bond markets are significant because they influence the cost of borrowing. Mm-hmm. Bond market consists of the government bond market and the corporate bond market. So if there is volatility in the bond market, in other words, if there is volatility in the yields, the interest rates that are operational in the bond market, that will influence the cost of borrowing of the government. And if the government's borrowing rises, mm-hmm. then it will have an impact on companies borrowing or raising funds. And if companies find it costly to raise funds, they will step back on their investments because they also need a ready supply of finance. They also need a ready supply of funds at low interest rates. And they need a liquid bond market with ample supply of buyers of bonds, including retail investors. Mm-hmm. Now, even retail investors, we know people like us, one option for us is a fixed deposit rate. But now we know that for us, the government bond investment is also open. In 2021, retail direct scheme was introduced by the government where retail investors can directly invest in the government securities market, both in the primary market as well as in the secondary market. So that is another investment option for households also, given the fact that fixed deposit rates are not very high and they haven't picked up as yet. So that's another investment option. So for people who want to diversify and yet have a safe investment option, bond market is a good option. So therefore, one needs to look at what is happening in the bond market from the viewpoint of government's cost of borrowing, companies' cost of borrowing, and also from households like us. We also want to diversify our investment options, not go into equity, which is considered to be more risky. Then for us, one of the investment options is to invest in government bonds.
We, like I said, the question was fleeing FPIs and volatile bond markets. So what comes first? The FPIs fleeing or the bond markets being volatile, or is it a chicken and egg question?
It's both happening simultaneously, and one is impacting the other, and the first is impacting the latter. So it's both factors are chicken and egg. Both are reinforcing each other. That is what we are seeing, driven by international factors and spillovers from what is happening globally. So we are seeing both the impacts happening. So in fact, bond market volatility is a repercussion of what is happening globally. And same is with the foreign investors fleeing the bond market. So
can we tackle the fleeing part first? Yeah. Why are FPIs quitting Indian debt markets?
Correct. Foreign portfolio investors, they invest in Indian financial markets, in both equity market as well as in the debt market. Now, in the debt market, there are certain limits placed. How much foreign investors can invest in the government bond market and in the corporate bond market. Now, what is happening is that whenever foreign investors are investing, they look at the returns, how much bonds are yielding returns. Now, because the US Federal Reserve has been raising rates and with the November 75 basis points rate hike, that is now the fourth consecutive 75 basis rate hike. What is happening is that the US bonds are offering a higher rate.
Return.
So typically what happens is that the Indian bond interest rates are always higher than the US bond. And on average, if you see for the last, say, 10 years, the yield differential, what is offered by the Indian bond and what is offered by the US bond, the yield differential is between 4.5% to 5%. That is the difference. And therefore, if foreign investors are investing in Indian bonds, they find it lucrative because Indian bond is offering 5% more than the US bond. Even considering exchange rate depreciation, because foreign investors investing in rupee bonds have to also tackle exchange rate risk. Overcoming that also, if you are getting a 5% return, it is satisfactory. Now what is happening is that because the Federal Reserve has been raising rates, therefore the yield differential, that is the difference between the Indian bond and the US bond, has narrowed. And as per the latest month, for which we have data for October, the differential has narrowed to less than 3.5%. From 5% till December 2021, we are at 3.5%. So that is leading to foreign portfolio investors fleeing the bond market because they don't find this 3.5% differential as lucrative enough, considering the exchange rate risk also. Indian currency is depreciating. So considering that risk also, this differential is not enough to incentivize them to invest, and therefore they are fleeing the markets and investing in other markets where the return is higher.
So that is part of the whole volatility. What is the larger volatility problem here with the impact on the economy, the liquidity issue here, and also the Indian banks are part of this whole problem. Can you elaborate a little bit on that, Radhika?
Sure. So again, why bond market is important is that any monetary policy action that we've been talking about, the US monetary policy action, the RBI's action, they have an impact firstly on the short-term rates. Okay, so the first impact whenever the Reserve Bank of India raises its policy repo rate, the first hit we see is on the call money rate. Now, call money rate is the rate at which banks borrow amongst themselves, which is an overnight interbank money market rate. So whenever the RBI raises interest rates, these short-term interest rates tend to rise. When the call money rate rises, the other short-term rates, when we say other short-term rates, 91-day treasury bill rate, 1-year government bond yield, they also start rising, which is what we are seeing now, that with the sustained tightening of monetary policy by the Reserve Bank of India, the bond yields have been picking up. The short-term bond yields, not so much the long-term bond yields, but because the immediate impact, as I said, is on the short-term bond yields. So now if I invest today at a particular interest rate, I have invested, but now if the interest rate rises further, I am at a loss because I invested at, say, 5% interest rate. Now the interest rates, because RBI raised initiated another round of rate hike, the yields on bonds rose further. So investors suffer losses. So unless there is this uncertainty, till there is this uncertainty about how much interest rates are going to rise, there is going to be this dilemma amongst investors whether to invest in bonds or not. And typically, who are the investors? Private sector banks, public sector banks, retail investors like us, foreign portfolio investors, and then there are these long-term investors like mutual funds, insurance companies, and so on. So they invest in different maturities of bonds. But banks are one of the most dominant investors in bonds, and we are seeing that they are also not investing too much in bonds, and that is causing this volatility, because unless you have a regular stream of buyers and sellers, that creates volatility in the yield, and that's directly a repercussion of monetary policy action. We do not know when the US Fed will stop. till the US Federal Reserve continues to hike interest rates, we will see fleeing of FPIs. That will have a bearing on Indian bond markets. Then we do not know how much RBI will raise interest rates, whether it will only rely on inflation data, or it will also look at what is happening in the US markets. So because ultimately it boils down to the question of uncertainty. There's so much of uncertainty regarding interest rates trajectory that yields have risen and there is less demand for bonds.
So what does it do to the entire liquidity situation? Because we have been talking about credit offtake, the fact that there was a liquidity crunch in the system a couple of weeks back, we spoke about it. And the fact that private credit offtake has been dependent on banks, but they're not able to borrow enough from banks, so they're raising funds independently outside the banking system. So what is the liquidity situation because of the impact of this bond market volatility?
Right. So one is what we spoke about, which is the uncertainty in the monetary policy announcements or direction that has a bearing on bond markets. The other is, which is a new feature which we are seeing now, is that because banks are seeing a huge resurgence in demand. If we look at the current data on credit, it's risen to around 17%. The year-on-year growth in bank credit is more than 17%, whereas deposits have risen by 9.5%. So what do banks do? Now, banks have various options. One, as you rightly pointed out, banks are raising funds through other means, like certificates of deposits, or they are offering lucrative rates on fixed deposits. We saw many videos where bank officials are carrying mics on the roads and, attracting households to invest in fixed deposits at 6.5% interest for 666 days. So banks adopted a lot of measures to incentivize households to invest in deposits. But that is one part of the story. And still we see a huge gap between credit and deposits. So that gap has to be bridged. One of the measure is tapping the other sources. The other thing what banks have been doing of late is that they are liquidating their securities holding, because we know that banks are major investors in government securities market. They are legally mandated to hold a certain percentage, which we call it as SLR, statutory liquidity ratio, where around 18% of their deposits they have to hold in the form of government securities. But we have seen, during COVID time, banks' investments in GSEC had risen disproportionately because there was no credit demand. Now we are seeing that the credit demand is picking up. So banks are now liquidating or dipping into their portfolio of government bonds and other bonds so that they can get money, they can get liquid cash to cater to the rising credit demand. So in other words, what they are doing is that they are selling or shelving their bond portfolio, which is also creating more supply and less demand. So again, whenever there is more supply and less demand, price of bond goes down and the yield rises. So that is another feature that we are seeing, that on the one side, monopole uncertainty, and on the other side, credit offtake and banking system, problem with the banking system liquidity, which is having a bearing on the bond market. So in other words, all these pieces, the entire financial system is so integrated that any volatility or any disequilibrium in one market spills over to the other market, which is what we are seeing of late.
So where do you see this going in terms of the yields and the returns on bonds, and how long do you see this volatility lasting? Because we are beginning to reach the end of this financial year, but the global scenario is quite still uncertain, and everybody is preparing for a recession, global recession in 2023. So what is what is in store, like we said in our question?
Right. So it's important to know that banks always think ahead of the policy movement. So they do price in some interest rate hikes. And if the policy moves in tandem with what is the market thinking, then we don't see major disruption happening in the yields and in the market. So with the 75 basis points hike that happened on November 2nd, the interest rate, the policy rate, which is called the federal funds rate in the US, it's already reached 3.75 to 4% range. Now, markets are already pricing a 5% interest rate. So if there is more a 50 basis points hike, that will not have a very disruptive impact on the bond market and therefore not have a very disruptive impact on the Indian markets, the spillover from the external market per se. But if there is some another unanticipated shock, if oil prices surge disproportionately, right now they are range bound. So unless and until there is some unanticipated shock, what the markets feel or what we see based on the trajectory is that the worst is over. Front loading of rate hikes has already happened. We are seeing commentary from, in terms of the commentary, though there is some contradiction because in the Federal Monetary Policy Statement, the governor said that, they will look at the cumulative impact of rate hikes, the lag. That was interpreted by the market in terms of seeing that they could go slow in raising rates. But when they actually gave a press statement, they said that no, we will still hike the rates. But nevertheless, the front loading of rate hikes may be over, and going forward, we should see that the interest rates will move range bound. There won't be very violent swings at least in the long term yields. Short term yields definitely are impacted by monetary policy action. So we will see there some uptick, but the point here is that the markets have already priced in some form of rate hikes over the next couple of months. So we should not see most of the volatility. What we have seen has already happened. Also, remember, October was a festive season, and also July-September quarter end also saw a lot of liquidity being sucked out of the system because of tax outflows, because of credit demand, because of festival season, and that also had a bearing on banking liquidity. So we should see some normalization happening over the next few months.
Let's take some questions, Radhika. It's a complicated subject, but we do have a few questions on bonds and FPIs. The first one is from Aditya. Thanks, Aditya, for being there and asking us questions every week without fail. Do you think the position of FPIs leaving India would change after the midterm polls in the US, which has just happened earlier this week, 8th of November? And once the inflation pressure eases out in the US, if the Fed does not decide to increase rates, can we see FPI moving to India again?
Yes. So as we discussed, if Federal Reserve starts going slow on interest rate hikes, if they do not raise by 75 basis points, even if they raise by 50 basis points, that will be treated as a positive feature where we will see FPI flows moving back. So in fact, if we look at the November data, as we were discussing, foreign portfolio investors' investment in equity has already picked up. So debt is more influenced by what is happening in the bond market in the US and other economies and what's happening in the Indian market. So that is more influenced by monetary policy. But yes, if interest rates hike goes slow, that would lead to inflows.
The next question is from Anindyo Kamal Sen. Hi, Anindya. Thanks for your question. Apart from inflation, can the problem of fleeing FPIs also be reversed by increasing our own policy rate?
If we look at the disclosures, if we look at the discussion around what are some of the shocks or some of the policy problem, in addition to Russia-Ukraine war and our current account deficit, one of the policy problem that is being highlighted is the sustained global monetary policy tightening. So that will have an impact on interest rates, though our central bank governors very clearly say that they will be driven by domestic considerations, that they will look at their own growth and in our growth and inflation data to decide on whether they will raise interest rates or not. But if there is a sustained interest rate hike in the US, that will have an impact on our currency. So interest rate could be used as a measure to support the rupee, and therefore that is also one of the considerations in determining interest rates.
Vinayak Sardesai has this question about FPI outflows and inflows. He says this month so far, that is November, FPIs have made net purchases of over rupees 8,000 crores in the stock markets. Even before that, in the later part of October, there have been more of net purchases by FPIs. Do you think it's because of the overall resilience in the Indian economy and the decoupling of Indian stock markets from other markets that FPIs are getting attracted to Indian stock markets? Further, do you think going ahead there will be more such investment by FPIs, which consequently could lead to Indian rupee getting stronger due to dollar inflows? We were talking about this because FPIs are getting out of the debt market, but FPIs are getting back into the equity market. So what's happening there?
Yeah. So if we step back a little and see what happened in September was particularly bad for both equity and debt because we saw net outflows from both equity and debt. Now what we are seeing is in October we saw that overall there was a very slight outflow because driven by outflows in debt, but it was to some extent offset by inflows in equity. What is happening again in equity is a different picture playing out in the primary market and in the secondary market. What's happening is that there have been some IPOs being announced, though they are smaller magnitude IPOs, but what is expected is that this momentum of IPOs will gather pace in the coming months. So FPIs are showing interest in the IPOs. We know that in the stock market parlance, they are called qualified institutional buyers. And qualified institutional buyers have a particular quota. They have a particular amount which they can invest. So they are, we are witnessing FPIs showing interest in the IPOs. Yeah. So that is what we are seeing. And even rightly pointed out, even in November, we are still now 10 days, we are seeing net inflows by FPIs in the equity market.
The last question is also from Aditya. Whenever we talk about FPIs, we usually talk about US-based investors. Are we seeing similar behavior from investors in other countries such as the UK, Europe, Australia, or do the investors tend to behave in a similar manner like the US?
They tend to behave in a similar manner because they have a relative position. You know, they have position in all markets. They look at the relative fundamentals of all markets. They look at emerging markets. They look at countries like Brazil and other commodity exporters where their currency has not fallen because they are exporters. So they tend to take positions based on the currency movement and the market fundamentals. So they tend to move in a herd behavior rather than having, we cannot distinguish between a US investor or UK investor because they are all institutional investors, and some of them are also part of institutions, like they are investing as a pension fund or a sovereign wealth fund or so on. So they are investing as a fund, as a pooled investment vehicle. So it's very difficult to disentangle based on different nationalities.
Okay. It's difficult to disentangle it based on different nationalities, but for us, FPI is FPI, wherever it is coming from. Thank you so much for watching this episode of Macro Sutra, bond markets, FPIs, and hopefully we will see some less volatility going forward in the coming months. And we are getting towards the end of a financial year, so we need to settle down in that aspect. We'll be back next week with another episode. Thank you so much for watching. Have a great weekend.